Hi, I'm Madison Malone, and today we are talking about tax residency, and I'm joined by Shanine and Ian from BDO. Thanks so much for being here. Shanine, let's start by talking about the relaxing of investor immigration settings to make New Zealand a more open for business place. For anybody who is thinking about making New Zealand their second home under these settings, what should they be thinking about?
That's a very good question, Madison. So what's happened recently since national government came on board was to relax the rules for investors to make it easier for them to migrate to New Zealand or make New Zealand their second home. So they are relaxing some of the requirements such as investment categories. They are making English not a mandatory requirement. They are relaxing the number of days that investors have to spend in New Zealand to gain residency, all of which is to signal New Zealand is open for business, New Zealand likes investors. Welcome to New Zealand.
So Ian, what are the tax settings that integrate with these new rules?
Well, tax residence is one of our fundamental building blocks to our tax system. If you're a tax resident, you're liable on your worldwide income. If you're a non-resident, you're only taxed on New Zealand sourced income. So becoming a tax resident becomes if you have a permanent place of abode in New Zealand. So if they come down on a long-term basis and buy a house, they'll have a permanent place of a home, even if they keep their home elsewhere, or if they spend 183 days in New Zealand in any 12-month calendar year. So there's tests around tax residence. We have a system of double tax agreements that provide a tiebreaker where if you're a resident in one country and a resident in the other country, you work out where you're more predominantly. The good news is that you don't necessarily have to have that all sorted out before they arrive, because most new migrants and returning New Zealanders who've been out of the country for more than 10 years are allowed a transitional period of about 48 months, but it can be extended depending on the facts and circumstances up to 54 months. That is a transitional exemption where they say, look, we're here to capture your New Zealand sourced income and any consulting and employment income that you continue to earn, even if you're consulting offshore. But all of your stocks and shares, your investments, your IR 401s, all of those are pension plans, stuff that would be caught under a foreign investment fund regime or financial arrangement rules. That's all foreign passive income. That's not taxed for that 48-month period. And then during those 4 years, you can decide if you like New Zealand, and we've had lots of clients who have spent the 4 years and said, I'm not going back. And then they have time to structure their affairs for going forward at that point in time.
So much to think about, Ian. Very interesting. Keen to talk to you in more detail about the fifth tax. How does that currently work? And why is the government looking at also changing that as part of relaxing these settings, Shanine?
Very good question, Madison. So the fifth tax, otherwise known as the Foreign Investment Fund regime, is aimed at New Zealand tax residents who hold offshore shares. So say, for example, you have $100 shares in Tesla, or probably more $1,000 shares in Tesla. Then what you will have to do is you'll be taxed on 5% of the price you pay for the Tesla shares, and it's building up 1.05% year on year. So for some new migrants to New Zealand, they might be in this tax space. So they will be holding shares in unlisted startups that has no readily market value. They can't really realize those shares because it's not that liquid, but every year they have to pay tax on 5% of the share value. So where do they stumble with the cash? They can't realize the shares. How do they know what the market value is? There's no ready market for it. So to target those situations, what the government is proposing is that those investors can choose, so it's by election, to be taxed on the realization basis. That means that they're only taxed when they sell the shares at 70% of the capital gain they made after they become New Zealand tax resident. Of course, if they receive dividends throughout their period of ownership, they will have to pay tax on it. So that's one particular incentive the government is proposing to help encourage new migrants. There's another change in the fifth rule as well, and this is more targeting those who continue to be taxed on a citizenship basis. So certain countries around the world, they continue to tax our citizens regardless of tax residency. So someone might be coming in from, say, America and choosing New Zealand as their second home. They will continue to be taxed on the citizenship basis because they remain a US citizen. In those situations, they'll be paying tax in both countries. And if the fifth rule operates, that means that they'll be taxed while they continue to hold our shares. And then when they eventually dispose of the shares, presumably US will be taxing them as well. So they'll be paying tax on both ends. that actually goes against the grain of tax, which is you should only pay tax once and once only on your gain. So what the government is proposing for those type of individuals who are still taxed on citizenship basis is that they can also elect to change to a realization basis. So they only pay tax when they sell the shares. And the idea is that at that point in time, they pay tax once in New Zealand. They can bring that tax credit to file their US tax return, and they can claim the credit and only pay the difference. So those are the two changes in the fifth rule that we're looking forward to be introduced by the government.
That would certainly make things more simple. Are there any other complexities that any new migrant to New Zealand should be aware of within this sort of tax regime?
I think another interesting thing that's coming up is probably the trust regime. Would you agree, Ian?
Sure.
Yes.
So we got if they've got trusts from overseas, they're foreign trusts, and when they come into New Zealand, they've got to look at that trust and look at whether it needs to elect into our New Zealand compliant trust, because if they become a non-compliant trust, the tax rate's 45% on distributions from that trust. So there is some planning to be done. Again, if they're in the 48-month transitional exemption period, there's a bit of time to do that planning. The other areas like pensions. If they've got pension plans and then they're looking to cash them up, we've moved from an accruals basis. Pensions used to get taxed under the fifth regime. They're now taxed on a cash basis when they are paid out or cashed out in a lump sum. But there are rules around how you calculate how much of that pension is taxed as income when you bring it out. Again, that might be decisions they have to make, which are based both on financial advice. So we don't want to cash it up to save tax and then find that you would have been better off keeping the investment. So we can't provide financial advice in that area. But these are the things that have to do. And the good thing is you potentially, if you qualify, got that 48-month period to take your time to work out those processes.
Well, it sounds like if anybody has any questions, they should absolutely come to you too. Really appreciate your insights, Ian and Janine. Thanks so much.